Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Neil Dutta joins us now. Neil, what does this signal for Chairman Powell?
Get going. That's what it signals. Go 50 with a promise to do as much as necessary to stabilize labor market conditions.
So again, Neil, and you think about these numbers and the revisions, as Tom was just summarizing here, the labor market, I guess it kind of falls into what you were just saying minutes ago, not nearly as strong as people think it is.
No, the 3-month trend on non-farm private payrolls is running below 100,000. That's not a good number. That's barely break even. And I think it's arguably actually worse than that, because one of the reasons why the number even looked as good as it did is because we saw an uptick in construction employment among, I think, civil engineer contractors or something like that. And so that's not going to last, because everything we know about construction right now is that units under construction are collapsing. So why are we hiring all these people to build what exactly? That implies a margin squeeze for builders, which I don't think they can tolerate right now. So I think it's the goods producing side. Tom mentioned manufacturing. I think that's notable because a lot of people were thinking maybe you'd see some uptick in manufacturing because of the unwind of the retooling. It just didn't happen, right? And the good side of the economy is weak. Cyclically sensitive industries are sluggish. This is all about the Fed trying to create a handoff from income-led growth to credit-led growth. That's what this is about. So they need to keep cutting until the credit-sensitive areas of the economy turn.
Joining us worldwide, Neil Dutta. We are commercial-free to the 9 o'clock hour. Claudia Sahm, Mark Zandi will join in a moment. Ben Laidler will join us on the equity market reaction and the view forward here later in these 20 minutes. Futures at negative 17. The VIX was a 22 level, comes in nicely, 20.76. Major bond market adjustments, make it 8 basis points. 2-year yield 3.66, 30-year bond well under 4%, 3.98%, 10-year yield 3.67%. Neil, I want you to frame out for us what inflation will do given a depressed GDP and the job market moving. The second derivative here is moving to a worser space. What does inflation then do? Further disinflation?
Absolutely. I think so. If you look at core goods, non-housing services, and housing rents, those are the 3 ways to slice the inflation data. The entire shortfall relative to the Fed's target is in housing rents, which we know will continue to normalize given the lagged, nature of that indicator relative to market-based rents. Everything else is basically normalized. What's the upside risk for inflation if growth is running below potential and the momentum under the unemployment rate is higher? Unit labor costs are running basically flat for the last year. So there's no more of an inflationary impulse coming out of the job market. That story is completely over. And the Fed continues to run a very, very restrictive policy stance.
Paul, get one more in here.
And Neil, the unemployment rate, just for those that are going to be watching the headlines, it stays steady at 4.2% here, right in line with expectations. What does the Fed think about an unemployment rate of 4.2%, do you think?
I don't think they should think about an unemployment rate of 4.2%. I think they should think about what's gone on over the last 6 months.
There you go.
Which is it's gone up.
No, it's absolutely
Neil
consistent.
Dutta, I know you got to publish. We'll feature that out on Twitter. Neil Dutta with RenMac will publish, and we thank him for careful market economic analysis. We now bring in Claudia Sahm, Chief Economist, New Century Advisors, and Dr. Mark Zandi, Chief Economist at Moody's. We had them on here, 30 or 60 days ago. Can't remember. It was just lights out. Great analysis. Claudia, I want to get this out of the way so we can move on to the real Claudia Sahm. I'm sick of the Sahm recession piñata. Can you just give us an update without tar and feathering your reputation? Are we close to a recession, Dr. Sahm?
So the increased unemployment rate is in a range where we have historically been in recessions, right? But that's a history, that's a past. We're not in a recession right now, but we do have a weakening labor market. Right. So that's the important takeaway. But not a recession right now, but a risk. Always a risk.
And what I remember from 2008 is the Zandi rule. There's the Sahm rule, right, but there's also the Zandi rule, which is to be optimistic about America. Mark Zandi, if we get the deck of cards I hear from Neil and others, and you, frankly, at Moody's as well, can corporations adjust and sustain off of a lower nominal GDP, decent revenue and decent earnings, or do you just suggest everything goes down?
Tom, I think they're doing just fine. I mean, looking at corporate earnings, they feel pretty good. I mean, through Q2 of 2024, double-digit year-over-year growth, and expectations of analysts always are on the high side, but they're still pretty good as well. So I think the economy is doing fine and producing enough revenue growth to keep profitability going strong. So yeah, I'm not worried about that. And just broadly, I'm all on board with the view that the Fed should be cutting rates and normalizing them very quickly. But today's report, I thought, pretty much down the strike zone. I mean, the kind of underlying job growth is 100 150K. That's kind of where you want it. 4.2% unemployment. That's kind of where you want it. You saw a tick up in hours worked per week. That's, feels pretty good. Wage growth is, almost exactly where you want it. I mean, yeah, you can split hairs, but come on. What are we going to say? This is a good report. This felt like a really good report to me.
Is it to the point there, Mark, where the Fed can stay at 25 basis points, or is this something that some are suggesting may push them to a 50 basis point cut in September?
Yeah, I think it's 25. I mean, I would expect the Fed to cut 50 only in emergency if, markets are really evaporating or there really was some serious deterioration in the economy, job market. But I don't see any of that. So I think it's a quarter point. And there's, I think there's good arguments to cut in a consistent way. But I don't think we need to dramatically cut all at once because there's a lot of reasonable uncertainty as to where the Fed should be going here. What is the so-called equilibrium federal funds rate? What's the rate where policy is neither supporting or restraining growth? That is very uncertain, and I think given that, I'd go cautiously unless pushed to do otherwise. And I in this report, I don't see any reason to feel like they have to move very quickly here.
Claudia, over the weekend you'll be at some fancy cocktail party, and somebody's going to come up to you and say, "Hey, Claudia, how's the U.S. labor market?" What's your response?
It's not headed in the right direction. This is the thing I'm most concerned about. Again, just, the numbers, the numbers themselves, okay, fine. It's just things have been slowing and weakening, and not because I am, hair on fire that a recession's around the corner. Right. I'm really concerned that we're slipping away of a really good labor market. And we need this as good as it gets. And there should be nothing weaker than what it takes to get inflation down. And we are, the train is still moving and is not in the right direction.
I mean, to both of you, and folks, we've got huge academic caliber here. Mark, I'm going to go to you first, and then Claudia, same question. The ECB is trying to teach us about being non-measured. Are we slaves, Mark Zandi, to a Greenspanian measured approach? Careful, careful, careful. Why can't we go X beeps or Y beeps or Z beeps and see what happens? Why can't we do that, Mark Zandi?
Well, I don't know, Tom, that you need to. I mean, if the labor market was falling apart, yeah, absolutely. If the financial system was in turmoil, yeah, I'd move more quickly. But the economy is it's throttling back, but that's exactly what you'd want to see it to throttle back. For it to throttle back here. It's been growing too strongly, and it's kind of coming right into where you want it, and no reason to move quickly otherwise. And again, I keep going back to I don't think anyone knows reasonably so where we're headed here. It feels like the equilibrium rate is higher than it has been typically, and it's moving. So why not go cautiously? And if things start to really deteriorate, if we do start to see really significant job loss or even very weak job growth. Hey, one other quick point, Tom, I wanted to make.
Please.
The August data is always weak. We get very low initial response rates in the month of August, I think for obvious reasons, people are on vacation. And we always get an initial print that's on the soft side. And almost invariably, if you cast me back a year from now, we're going to be talking about upward revisions to the data. So, you just have to take that into consideration.
Yeah. Claudia, I got a 3-month moving average of 116,333, 116,333. I'm sorry, but that's way below anything I've seen as a normal rate of unemployment. If you take the 3-month moving average, Jason Furman will help out on this at Harvard. I'm sorry, Claudia, is measured in place, or is this a Fed that's got to go ad hoc forward?
I think, again, it's like looking at how the variables are changing. The unemployment rate has been rising. Yes, it is still relatively low historically. We also have an older workforce. 4.3% is not that far from and experienced and esteemed, right? And so there's no magic number with the unemployment rate. It's watching the dynamics. It's watching the change and knowing that once that change is in place, the Fed has been trying for 2 years to cool off the labor market. That's why the funds rate is at 5% and other types of demand, right? So yes, things are cooling off. And now it's like, okay, now we need to turn that around. We don't need that slowing. So I think that changes everything.
Wonderful. Zam and Sandy with us right now. They move the market higher. Futures negative 30, now negative 12. Deterioration in the Sweeney yield, 2-year yield from negative 7 basis points down to negative 9. Those levels, 365, 2-year, 368, 10-year, 30-year bond under 4%. Paul, you home shopping this weekend?
I might be, absolutely. Red headline crossing the Bloomberg terminal. Traders price in 50% chance of half-point Fed cut this month crossing the Bloomberg terminal. Mark, Zandi, given the labor outlook here and some of the data we got today as it relates to total payrolls and wages, what's your view of the U.S. consumer here? How healthy or how at risk is the U.S. consumer?
I think in aggregate, if looking across all Americans, they're continuing to do their part. They're hanging tough. I mean, the train is being driven by folks in the top part of the income distribution. And, I don't think it's hyperbole, but their financial situation is probably as good as it's ever been. Got a job, strong real wage gains. They own stocks. Stocks are near record highs. They own a home. Home values are near record highs. If they've got any debt at all, it's a 30 or 15-year fixed rate mortgage locked in, and it seems like everyone I talk to has a mortgage at 2.5% or 3% locked in. So by my calculation, they still have some excess cash that they built up during the pandemic when they couldn't spend that they're spending down now. So I think they're fine. I do think the soft spot obviously is lower income households. They clearly are struggling. They got nailed by the high inflation. They took on a lot of debt to supplement their income, to maintain their purchasing power. And it's one thing when rates are low, but when rates are really high, that means the credit card rate is 22%, a record high. That's very painful. They don't own stocks. They don't own a home. They rent. So, very different kind of perspectives. But, at the end of the day, it's the folks in the top middle parts of the distribution that
here we go.
Are critical here.
I mean, I can't keep up. We tried to get John Williams on the show. Yep. Claudia Sahm, Mark Zandi, John Williams. That would have been good. New York Fed President John Williams says now appropriate to lower Fed funds rate. Claudia, when you were studying this at Michigan, this ex post lag, is this unusual the way our Fed is acting?
Yes, particularly in the way monetary policy is quote unquote supposed to be done, like in the theories, right? But that's a very clean, not realistic state. I understand why the Fed when tools start breaking down and data don't make as much sense, then you kind of crawl your way along and you want evidence. I think this Fed did lean into a very Fed-like tendency of being super, super cautious, and they have been kind of greedy in terms of how much data they wanted on inflation. And if I had to hear so many times, we have the luxury of time because the labor market is so strong. It's like, well, guess what? It actually wasn't as strong. And so there's a cost. Like they took time to get comfortable with inflation, but that probably means they do not have time to get, is the labor market really weakening? Like they may need to recalibrate some and get going, I think would be the appropriate, but this is really outside of their playbook. So I understand why this is a hard case to make.
Dr. Zandi, you're a pinata for the gloom crew. I mean, 07, 08, 09, you said, everybody shut up, we're going to fix this. Zandi, pandemic, everybody shut up, we're going to fix this. Give us an optimistic touch here on how America will clear these traumas post-pandemic. China's slowing down. Claudia Sam's cats are miserable. Mark Zandi, just as directly as you can, give us, I need some Zandi optimism now, or I can't get through the weekend.
Really, I've got that reputation. I didn't know that I'm that optimistic. Well, look, just look at the numbers. I mean, top 4.2% unemployment. I mean, okay, maybe be nicer if it were 4. I'm on board with that. I mean, it's maybe on the soft side of full employment. 4.2% unemployment. We're creating a lot of jobs across lots of different industries and have been for quite some time. Inflation, that's back in the bottle, almost no matter how you measure it. So we're growing at a potential. And by the way, here's the thing that's really, makes me encouraged. The economy's potential is very strong. I mean, we're seeing a lot of labor force growth. Well, that's the key reason why unemployment is notched higher here over the past year. That goes to immigration, and there's a lot of cost there, but the benefit obviously is the strong labor force growth. And look at those productivity growth numbers, and I mean, it's hard to argue whether it's sustainable or not, but it feels like there's a lot of good things happening underneath. All the business formation we've been getting since the pandemic hit, it's probably reaping benefit, and this is all before AI kind of kicks in. So you add up all the productivity gains, you add in the labor force growth, and that's a strong, growing economy. And the trick for the Fed here is, let the economy take the foot off the brakes sufficiently to allow the economy to grow at its higher potential. That's a very different issue or problem if demand were evaporating. That's not what's going on here. So, objectively, take a step back and take a look around. This economy is good.
Paul, one quick question to Claudia Sahm, because futures just went green, which is a signal, go Ben Laidler.
There you go.
So quickly here, Paul, go to Claudia, and then we got to drag Ben Laidler in here.
Claudia Sahm, I mean, again, how do you when you sit back, you've had a few minutes to digest this, how's the Fed, how do you think they're going to digest these numbers today?
I think the payroll numbers are going to be the concern. And frankly, the piece of it that I found most disconcerting are the July revision, the earlier revisions, right? The hiring rate has gotten to too low of a place, and we're seeing it in the job gains. And then to see it, July was actually even a little worse than we thought on the jobs number. And so that, Claudia, I think that takes some pause.
She said, I was supposed to have dinner with Claudia in Jackson Hole. You know what they served? Elk, and the health food was venison. I mean, there's no fish or nothing. Claudia Sahm, we got to go. Thank you so much. Claudia Sahm, just nailing these revisions. I want to mention Anna Wong as well at Bloomberg. And Mark Zandi, thank you so much for being with us. Really appreciate from Moody's his optimism on the American economic experiment. He is the bull strategist who has nailed the trip from 2018, from Christmas Eve of 2018. Ben Laidler joins us right now in this market. Ben Laidler, are you going to cash?
No.
I'm just busting his chops.
I just killed my keyboard here. No, I think this is I think we're in the early innings of a bull market. I think the Fed cut, which is just around the corner, and which we're all sort of navel gazing over, I think is the trigger for this bull market to broaden both by sector and by geography. I think the data today probably a little bit weaker than bulls like I would have liked, and it's probably a recipe for a little bit more uncertainty. But bottom line, I don't think it really changes the trajectory. I mean, this is an economy that is slowing. We want it to slow, to pull forward those rate cuts. The Fed has a lot of room to cut here. I think that will stabilize the U.S. economy, and I think that will be very, very bullish for the rest of the world.
He's from the United Kingdom. We should properly introduce him. Ben Laidler, Bradesco BBI, with us right now. Paul?
The same question I asked Claudia Sahm, Ben, is how do you think the Federal Reserve will digest this labor data today?
Yeah, it's probably a little bit weaker than I would have liked, and probably that they would have liked. I mean, I guess we'd all be looking for that sort of Goldilocks number that last month was an aberration. Last month probably wasn't an aberration, even though the numbers were revised down a little bit today. So I think they're probably leaning a little bit more towards 50, but I think bottom line, they're going to get started. Inflation break-evens are at 2%. They've a lot of room to cut here if they feel that they need. I would like to see them get started. Right. And I think the chances for a 50 basis point cut probably increased a little bit, but I'm not sweating the pace, I think, too much. I think there's a lot of moving parts here. I think overall this is an economy which is slowing, but let's not lose some perspective here. I mean, this is an economy that we just had a 3% inflation GDP print last quarter. That's nearly double potential GDP. Unemployment just over 4%. I mean, we're coming from the start point is a very good place.
Given that backdrop, Ben, given the fact that we've got rates likely coming down, we got through a pretty solid earnings period in Q2. What are the sectors that screen well for you guys?
So I think the biggest call right now is not necessarily the direction of the market, which I think is pretty well set and up and to the right. I think it's more about the sectors you own and which parts of the world you own. I think this is a broadening bull market. I think tech's been a great place to be. It's nothing wrong with tech, but I think the bits of the world and the sectors that are much more sensitive to these interest rate cuts which are coming, it's not the US and it's not tech. It's basically everybody else. All these are the bits of the market that we've forgotten about for the last 10 years. That's, I think, where you should be kicking the tires on right now.
Ben, I don't have Apple in front of me, but you were way out front. 2018, 22, 23 and all. I'm hearing, Paul, you're hearing a lot of death of big tech. I am. Ben Laidler on the Mag 7, the Mag 8, including Berkshire. You still got to own them, right?
Yeah, I think so. The earnings numbers are decelerating, but they're still, no one else comes even close. You've got these fortress balance sheets. You've got these huge profit margins. With all that, I can more than justify, the valuations. But we all know that they're posting strong growth. The valuations are, already a premium numbers. That's not, I don't think, where the surprise is going to come. That's not where the sensitivity to lower interest rates is coming from. It's everybody else that has those shriveled profit margins, that has those, depressed earnings expectations. We've just come out of an earnings recession where valuations are 40, 50% lower. That's where I think you're going to get the bang for your buck in this sort of broadening bull market and potential change in leadership.
Too short a visit. We got to get Ben Laidler on again. Next time Tottenham wins, we'll get Ben Laidler on. Ben Laidler, thank you so much with Bradesco. Joining us now, Denise Chisholm with really one of the most interesting jobs at Fidelity Boston, Director of Quantitative Market Strategy, and with a legacy of quant and technical at Fidelity. The heritage of what Denise Chisholm does is a big deal. Denise, are we in a bull market?
Well, you just said it's green, so I think that that's a good start. I mean, I think that that's the question in terms of what the labor market actually means to the overall stock market. And people are struggling with the Fed's cutting interest rates. Is that necessarily a bad thing? Half the time in history, it has been the Fed's cutting because they have to. But half the time in history, the Fed is cutting because they can. And that's the part that I look at in terms of the data is what is unique about this cycle and what is predictive about this cycle. And when you look at bull markets and when you look at the weakening of the labor market, in some ways, the Fed cutting doesn't really add much to market returns when you roll all the data past 1962, which we might be focusing on the wrong metric.
But Peter,
what actually has mattered historically is earnings growth.
Yeah,
And
okay,
that's
but
a big difference.
Denise, when Peter Lynch didn't have to worry about a pandemic, do you have to adjust your work with Uri and Timmer? Do you have to adjust your work because you're coming out of a pandemic?
Always in the sense that there are no analogs that can help you. So to your point, it is always different this time. And there are a lot of differences in the data. So what you can do is to study those differences, to see if those differences are predictive, and to find out what those differences mean to the overall stock market. Unemployment rate is actually a great indicator to study, because as much as we're all laser focused on it, what you'll find is when you look back in history, a rise in the unemployment rate, such that we've seen, isn't necessarily bearish for the overall market. In fact, some of the time, even when the stock market's gone up, so some of that is recessionary fears, but even when the stock market's gone up before it, a rise in the unemployment rate hadn't been a problem, because some of that, historically speaking, like the mid-60s and the mid-90s, is driven by an increase in labor supply. So the nuances in the data, the study of history, can actually help you identify the differences and help you understand what is predictive on a go-forward basis.
All right, we're speaking to Denise Chisholm, Director of Quantitative Market Strategy, Fidelity. Remember, up in Boston time, we're now on 96.9 FM. Big signal up there, so for our friends in New England. Denise, if I talk to equity bulls here, they're telling me I've got a pretty solid earnings backdrop. I've got a Fed that's about to cut rates. That sounds pretty constructive. What are the black boxes of the Fidelity quantitative group? What are they saying these days?
Yeah, I will say I'm not a black box quant, so I'm not systematic by nature. As we just talked about, it is always different, so I like to evaluate those differences. And that's the part that's interesting about the Fed cut. I think that you hear a lot of strategists say, well, this is a bullish thing because it's adding to accommodation, or this is a bearish thing because the last two times the Fed's been cutting, it's been because we've been in a recession. So I think that the struggle around that data is what is unique. And to me, what is very unique this cycle is the elevated level of the Fed funds rate itself, now above 5, with the juxtaposition of inflation actually being below average or below 3. And that, as much as it sounds very restrictive in terms of monetary policy, when you look at that historically, that's actually been a really good setup for the equity market because the Fed has the ability to cut.
Okay, but what's the linkage here of the Fed to an equity account? I mean, let's say somebody owns a few shares of Will Danoff up at Fidelity. What is the linkage here of Fed action now to Danoff's contra fund? I don't get the linkage.
Well, there's not a big linkage. What I just said was, in some ways, when the Fed is cutting interest rates, your equity market returns will Danoff aside. Your equity market returns run around the same average as when the Fed is hiking interest rates. So there's not a big differentiation in terms of what's the value proposition to own any given fund because of the Fed. And I think that that's the key factor that I want to change the investor focus to, all about the Fed, all about an indicator that really has provided very little signal when you look historically, because it's the why behind the Fed that matters. The parts of the data that can help us understand that why are things like bank willingness to lend, earnings growth, the acceleration in leading indicators. And right now, data can always change. They're actually pointing in a fairly constructive direction.
Okay. Denise, thank you so much. Denise Chisholm joining us from Boston. We continue strong. Stuart Kaiser joins us now, head of U.S. equity trading strategy at Citigroup here. And the word he used coming into the studio is it's not like early August. This time is confusing. Describe our confusion, Mr. Kaiser.
Yeah, good morning. Look, I think you got the payroll print right in the middle of the range, and that's probably the most confusing outcome for equity markets. Is it low enough for the Fed to cut? Is it high enough to believe the economy is still resilient? And if I'm an equity investor, how do I kind of respond to that? Unemployment rate about flat, so you didn't get a signal there either. So I think equities are probably going to take their cue from the rates market at this point. And you guys were looking at the WARP before, and how much cut is priced into there. The equities are probably going to take a pretty big signal from, because I think the data today was just not as informative as it could have been.
So on your desk at the Citi trading desk at 490 Greenwich Avenue, downtown Manhattan, what are they saying? Are you guys taking positions? You taking risk for your clients, or maybe just waiting to get more data, to get more conviction one way or the other?
I think this week has largely been a sit on your hands type of week and wait for the data to come out. And I think that applies to the banks. And I think that applies to clients as well. You had a sell-off on Monday. Maybe in a typical week, you might have had a little bit of a buy the dip mentality. But I think a lot of folks said, how can I add risk ahead of this event?
In your experience, if you get an Andrew Hollenhorst market, where Citigroup's been out front saying there's going to be a rapidity to the rate cuts, the corporate world's assuaged by that. I mean, corporations adjust given a new lower rate regime, right?
Yeah, I think corporates would like it in terms of balance sheet management, refinancing, things of that nature. Yeah. Equity markets will not like it. I think if you have to cut 50 because growth is slowing that rapidly, equity markets are not going to get enough support from rates initially. Obviously, eventually markets will stabilize, but the initial reaction, I think, to a 50 basis point cut would be, wow, they clearly believe that they're too restricted.
Okay, cut to the chase here. It's the end of the year. Everybody's in a panic to stay employed somewhere in the vicinity of March 31. Are we going to see strategists cutting their S&P outlook?
I don't think they're going to cut for this year. I think, what they do for 2025 will be pretty interesting. I mean, 2024 is almost baked in the cake at this point. Earnings have been pretty solid. Equity markets are up mid double digits. I think the question is going to be, if we are decelerating from a growth perspective, what does that 2025 EPS number look like? And you could have a little bit of a balancing act here, right? Where earnings growth is slowing a bit, but you're getting some rate cuts, which are supportive for valuation. So it'll be something for everything type outlook. But to me, it's the 2025 EPS number. What does that look like for next year will be the key.
Tom, Morgan Stanley's U.S. economics research team is out with a note here saying modest rebound in jobs, easing coming, probably 25 basis points. So they're sticking with their 25 basis point forecast there at Morgan Stanley. Stuart, given that, is this now going to be an earnings-driven market, do you think? Is that kind of what's going to be the primary determinant going into next year?
I think early next year will be. I think the next couple of weeks, months are just going to be very much macro-driven.
Okay.
I mean, we need to see what the Fed is going to do. We need to see if this slowdown in the jobs data is real. We need to see, what kind of momentum we have to the upside in the unemployment rate. So earnings will matter, but it's very hard for earnings to matter if the Fed is cutting 50 or if the labor market is printing, let's say, sub 100K jobs.
Good morning across the nation. 99.1 FM Boston, Bloomberg 11.3 our flagship network. Here in New York, good morning, 92.9 FM Boston. Thrilled that you're with us. Thanks for the feedback. I'm going to go to 313 this morning. SPX futures cratered. We're up over 1.1% now. Dow up 220. SPX green up 18. NASDAQ lags a little bit. The VIX from a 22 handle. It's a Stuart Kaiser derivative. Paul Sweeney, we're into an 18.86 in a stick. 3 big figure move on the VIX. That's all you got to know.
Absolutely, Tom. Stuart, what sectors look good to you guys at Citi these days? Given we're in a pretty decent earnings environment, it looks like we've got rates coming down. What sectors screen well for you guys?
Yeah, look, a lot of that's going to have to do with how the economic growth, kind of evolves itself. I would say that, if you want to stay in the growth trade, the stuff that's underperformed has kind of been more in healthcare. On the cyclical side, I think
But healthcare's underperformed, right?
It has, but I mean, if you want to be in growth, but you're a little bit worried about tech risk reward, for instance, I think healthcare will be a second option there. I think there's a lot of folks that are very positive of financials and banks ahead of the election. The other sector, and I'm not sure that we necessarily have a strong view on it, is energy, which has lagged so much. But is very much in that cyclical camp. So to me, as a house, as Tom mentioned, Andrew Hollenhorst has a recession back half of the year. So I think that means you need to be relatively conservative in terms of how you're allocating stuff. That puts you in things, I think, like healthcare and staples and the like. To me, the wild card there is tech. If you looked at it fundamentally, you'd say this thing is defensive. If you look at it from a positioning perspective, you'd say there's a lot of embedded risk there. And if you saw what happened Monday positioning took over that trade. So I think tech to me is the one that has the most debate right now.
How about AI? Is the AI
frenzy
AI over? Is that?
We haven't mentioned it all week.
I know. That's what I'm thinking. Is it now? Is that peaked a little bit? We kind of hit post or peak AI?
It does feel like that a bit, just in the sense of you saw Broadcom overnight traded off, NVIDIA traded off on earnings. You're kind of waiting until early next year to see what the new chipset out of NVIDIA does.
Come on. It's September 30. We're going to go out 4 weeks, October 1 to October 10. It's going to be a freaking frenzy of AI nirvana, right?
We'll see, Tom, because I do think sentiment has shifted a bit. People are very hesitant to buy the CapEx spending right now. The people that are spending CapEx on II, I think people are a little cautious about. And I think on the recipients, which would be Broadcom and NVIDIA primarily, people are a little concerned about, the continued upside to revenue outlooks and where the valuation is. So, yes, in earnings, going to be a huge talking point. Whether those stocks respond will be interesting.
Is your trading desk like the show industry? I mean, is it that nuts over at Citigroup?
It used to
be. Are they throwing things at you?
I've never seen the show industry. I haven't had anything thrown at me in at least 20 years, though. But that's because I'm a friendly guy.
I mean, how has a trading desk changed from Paul Sweeney was taking them out to $300 lunches 30 years ago?
It's a lot quieter than it used to be, honestly. Big news comes out, you don't hear people yelling, you hear the ting, ting, ting of the computers, right?
That's because they're watching Bloomberg surveillance.
Of course, they can't concentrate on the markets.
That's the story of life. I look, Stuart, here at this bull market, and we walked in here, slit your wrists at 5 a.m. Futures negative 30. We've done like a 40-point swing in SPX futures today. Is that the future? I mean, is that what Q4 lays out to be?
I think for the next couple of months, the market's going to be very, very sensitive and jumpy on any growth data. I think we saw that on ISM earlier this week. To your point, this was viewed as a very binary event. If we print above consensus, the market's going to recover because all of this slowdown, fear was overdone. If we print, sub 125K, it's recession around the corner, we need to sell off. So I think that what we got was something in between, which has sort of stabilized markets, but not resolved the confusion or sorted out the uncertainty. So that means the next month or two, incoming growth data, much more important than it's been for at least the last 2 years.
There you go. I mean, we're data dependent, Tom, but it's not.
We're data dependent.
I guess so, but again.
The one common theme I would suggest is everyone agrees the Fed's way behind.
Yes.
Whether right or wrong. Stuart Kaiser, thank you so much for joining us today. Your daily look at the front page is Lisa.
All right, we're starting with TikTok. They had that possible ban going out. Apparently, it's losing American support. So Bloomberg has the story out. It's a survey from Pew Research. It showed many Americans, they shifted their stance in the past year and a half. So just 32% U.S. adults backed the TikTok ban. That was compared to 38% last fall. And this is not kids. This is adults. These are adults that are surveyed for this. So it didn't ask them why their opinion changed, because I was asking, well, what's the difference? Why are they thinking different? It didn't say why they changed. They did say that it's divided along party lines. That's a difference there. But
Paul, do you use TikTok?
I do not.
Lisa, do you use TikTok? Come on.
Only to follow my kid.
Oh, so you say.
Exactly. But still the issue is, it's owned by ByteDance, which is a Chinese company, and so the risk of having U.S. consumer data owned by a Chinese company, that's the risk. Is it still with the government? Is the government thinking about what to do? Is that kind of where we are now?
That's where it is. They have until January to basically sell the app or face the ban.
Oh, okay. Because that was signed. That's a law signed by President Biden. So something's going to happen.
Correct.
Okay.
My amateur take is everybody's trying to be the new TikTok. Everybody wants the short attention span.
Yeah,
generally
short
cutesy
videos.
by kids, little, Instagram, all of them.
You can get lost in that for hours.
You just keep scrolling and scrolling for like 20 minutes.
Should we talk to Tom Secunda about TikTok on the Bloomberg Professional Service?
Yeah,
that would work out.
Yeah,
Next.
that would work out.
We have to get him on Bloomberg. Okay, this is from the Wall Street Journal. There's been this battle of public versus private beaches. This is along Florida's coastline. It's actually Walton County. 26 miles, beautiful beaches, all right? But half the beach is private, so only residents can do it. So a lot of beachgoers, they have to do these big signs that are put out. There's even security guards, so if you're not part of the private beach, you have to stay out. So the public beaches are now packed. This, though, has been a law forever. Like, it's been around for a long time. The reason why it's an issue now is because it's becoming more crowded, more developed.
Is it state by state? Because some of the New England climes I've been in, it's just understood it's private. But then the great venture capitalist Vinod Khosla had a running battle in California for years with your kids walking across his beach.
I know. Well, California, having owned a home there for a long time, all open. I mean, and dogs are, it's all completely open. New Jersey, Probably, you have to have the badges.
I
you have
pay.
to buy badges.
I pay to go on the beach in New Jersey.
Yeah, I mean,
about $13
and they say, oh, it's for the maintenance of the beach and replenishment of the beach, and I don't know. But
So
people
what's
are shocked
happening in
when they come
Florida?
to New Jersey.
So because of that in Florida, it's this battle between, the residents and people who are visiting. So now they want the law to change, but the people who live there saying, hey, this has been the law
I'll tell you,
since
the
forever.
beaches on Destin, Florida,
beautiful.
The nicest beaches I think I've ever been on. The perfect sand, water, just extraordinary there. You wouldn't think it, but it's awesome.
But they say it's not fair. All right. Still for sale 12 years later. We've been talking about the housing market, right? Houses going off like this. I mean, I'm being outbid left and right. But you know whose house is still up for sale? Michael Jordan. Yes, his mansion. His estate north of Chicago, 56,000 square foot home. It first listed for $29 million back in 2012. Later dropped to about $15 million. It's still unsold.
Wow.
The reason why, experts are saying it's just too Michael Jordan, right? It's highly personalized. That's kind of tough to sell. It has this big entrance gate with the 2-3, on the gate. A lot of flags with a silhouette across it. The movie theater has his, silhouette. He has these certain things like the doors from the Playboy Mansion. And here's the biggest part is that it's about 2 miles west of the waterfront houses that are lining Lake Michigan, where everyone wants to be.
Right.
So Michael Jordan wanted to be private, so he
Okay,
moved away
but-
from there.
Doesn't he clear the market this weekend with an open house and drop the price? I mean, that's usually
But
what you do.
He's been paying housekeepers, managers, security staff. He's paid over $1 million in taxes since it was listed back in 2012.
56,000 square feet.
huge.
That's the size of Delaware.
Yeah, exactly. I mean, it's just unbelievable. But hey,
Rhode
I
Island.
guess
No
he
one
can afford
wants
to
it.
wait. But I mean, like
Exactly,
enough is
that's the
enough.
thing.
Just
He can afford
I would
to
just
wait.
say to him, just move it, whatever price he needs. Put it up to auction.
And finally, now you're up for the iPhone update, correct,
Yes.
Paul? Okay, you're
Boom.
going for it.
Next week.
Here's what you might get, okay? I know you're not a big social media person,
Exactly.
but Apple has cleared WeChat ahead of that iPhone 16 debut. WeChat, it's like this Instagram-like WeChat Moments. It has live streaming.
Been in China.
Yeah, yes, exactly. China's Tencent. That's who owns it. It's a big deal because Apple approving that update basically eases those concerns that a dispute over fees, it could block the app. So this is a big thing that's happening with the new iPhone 16. So there you go. You'll have that update.
I used
when you
WeChat
get
when one of my kids was in Europe for a
you
semester
did?
because it's just you can call and do all that stuff and it's free and I don't know. So she just said use WeChat, Dad.
Yeah.
But that's it. I don't use it anymore.
Well, it's different from WhatsApp. WhatsApp is a different thing.
What I get them confused.
Yes.
Well, thank you, Lisa Mateo with the newspapers. Thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.